All right, listen, I know I've got a reputation for being a permer bull on the markets, but I'm just a permer bull when it comes to great American companies, not the whole market. Nevertheless, I think I said something to Neil Cavuto earlier today that probably caught him off guard when we discussed the possible reaction to the Fed if they don't hike rates. I think they're going to hike rates. I think Janet Yellen has gone out on a limb. They have almost zero credibility. I'm talking like almost zero.
You got to do this because you said you do.
Right, right. And that's where
they don't.
That's where. Well, then I think if they don't, the Dow's off 1,000 points. Joining me now, Hilary Kramer, A&G Capital President and CIO, and Dan Shaffer, Shaffer Asset Management President. And back with me also, Steve Moore. Steve, I'll start with you. A, what do you think Yellen's going to do? And B, what do you think the reaction is going to be?
Well, Charles, did I hear you say you do not think that the Fed is going to raise rates?
I think that they will. I said if they don't, I think the market crashes.
Okay, look, I think they are. The question is whether it be a quarter point or a half a point. And I'm with you. Look, I think that this is necessary to actually provide some calming to the market and to provide some reassurance that there's some fundamental strength in this economy. Now, I don't think it's strong, but I don't think it's going to, to sink into the bottom of the sea. And quite frankly, after 7 years of zero interest rates that haven't worked all that well to get growth, I think getting off zero is a smart course, and I agree with you. It's going to actually, I think it might actually bump up stock values, not crash them.
I mean, historically, going back to the 1950s, at the beginning of a new rate hike cycle has seen the market up big time, at least a year, sometimes even further out. But this time, Hilary, it's a little different because Steve hit on it. If the economy is doing well, a lot of people feel like, Yellen is doing this mostly as a symbolic move and that the economic underpinnings that should be there aren't, which makes things even worse.
That's absolutely right, Charles, and that's why you really, really are so right in that if she, for some reason, Janet Yellen, decides not to raise rates and to say, oh, look, oil prices are down, there's some deflation, we can't do this, yeah, the market is off so big and it's really setting us up for disaster. But indeed, she needs to do this, but then it's no guarantee that we have this rally that is sustainable for years, even though, of course, yes, I'm a permanent.
Well, we know short term it's going to be volatile. It's already been volatile. Look at today's session, look at last week, Dan. How do you think it's going to play out?
The scenario that's lining up based on the way I trade and manage my clients' money is that either way, it looks like the market wants to go down into December 21st to 24th. And the trigger is going to be in the language that they come out with, not just what they're going to do. Now, I'm in the camp that they're not going to do anything. I do not think they're going to raise rates, and I actually think they're going to turn dovish. And that's going to spook the markets because give me a reason why they should raise rates. You got iron ore collapsing, metals collapsing, commodities collapsing.
Because she said she would. Janet Yellen said she would. It has to do with credibility.
The ISM manufacturing number came in for the last 2 years now negative, below 50 is negative. How could the Federal Reserve raise that rate? They missed their window in 2014 when unemployment went to 5.5.
We've got 30 seconds, though, Steve. By the same token, you said this, and I agree. All these extraordinary measures have not worked, so why continue the risk, particularly when ultimately it's going to hit the taxpayer?
Yeah, there's no. I just feel like there's no turning back right now. I mean, they've got to do this, and let's not forget that the problems with the American economy right now, Charles, in terms of Washington, are not monetary. They are regulatory and they're tax. And until we fix those, we're not going to see the kind of hyper growth that you and I want to see.
Yeah, an avalanche of new rules, higher taxes, and an administration that hates to see people make money.
Yep.
Yeah. Okay. Thanks a lot, guys.